Hello everyone, this is Ashish with Investor Friendly CPA again. We are just making more videos on tax planning. This is another video that explains C Corporation and how you should be taking money out of C Corporation. Now remember, if C Corporation is good for you, if C Corp is good for you, that is the first step. You need to talk to your tax advisor. After that, if it's absolutely necessary, how to manage money out of C Corp is what I'm talking about today. So let me show you my screen here. This is our tax planning module. You guys have seen this before if you follow us. We do a bunch of tax planning for our clients, and one of the modules talks about C Corp, right? So I'm going to go to C Corp analysis and see what we got, okay? Here's a C Corp tax analysis. I'm going to do a full screen here and then show you guys. So how does this work? I just want to repeat this again. You guys have seen me talk about this before. Your tax savings, what you see down here, your tax calculations, it's really dependent on what's happening with your other life. Your W-2s or the business, your real estate. You just go up here and look at the formulas. It's just not as simple as you have 21% corporate tax rate. Okay, there's a lot of things that goes into this analysis, meaning are you already over the FICA limit? Do you pay extra Medicare tax? Do you have other self-employment income? That all affects your tax savings on every single aspect of your tax calculation. Okay, so make sure when you do the tax planning, those are already factored in, which we do in a very detailed manner. I know you guys don't see this on my screen. If I were to show you the actual calculation and how everything is calculated, it's right here. You guys don't need to worry about that. That's our problem, right? We do that for you guys. What you need to focus on is end result, what's going to happen. So if you see on my screen, what am I showing you? I'm showing you for this client, which happens to be me, right? If I'm already, let's say if I go to this screen here, if I'm saying I'm already making $200,000, my spouse is already making $100,000, I have another Schedule C business, let's say my spouse has $25,000 of Schedule C business, sole proprietorship, and for some reason I have C Corporation. How does that affect my tax savings? Okay, I live in Georgia, there's no city tax rate, let's say, I'm going to remove that. So let's talk about how C Corp distribution affects and what should you be doing. So let me pull that up again and show you guys. So we're not talking about S Corporation. C Corp, this is very simple. If I had to get a C Corporation for some reason, and then let's say I have a net income of $150,000, which you see right here. My C Corp makes $150,000. How should I take that money out? Okay, now this is where it gets tricky. Is C Corp saving you taxes or not is what you need to decide. If C Corp is saving you tax, then it makes sense. If C Corp is not saving you tax, then you really need to focus on other kind of entity. But if you already know C Corp is saving you taxes to some extent, how should you take out that money from C Corp is what we're going to talk about today. The four ways. Okay, you can take the money out as a shareholder loan. It does not impact your income tax to some extent. Okay, there's going to be some interest income you're going to have to pay taxes on. That's what this $900 is. Not that $150,000, even if you take out entire $150,000 is not going to be taxable. However, let's say what happens if you take it out as a 1099 income? What happens if you take it out as a W-2 income, right? What happens if you take it out as a dividend, like normal distribution? Well, that's what most people do. That's what the double taxation is. That's what I want to talk to you about. This is why C Corps are so bad. If your company makes $150,000, you not only pay corporate tax rate, which is $31,000, 21%, you're also going to pay double taxation, meaning at your marginal tax rate, whatever your marginal tax rate is, you're going to pay dividend income here, right here, $52,000. That's $84,000 tax in the $150,000 net income. You do not want this. So what should you be doing? There are three other ways right here I'm showing you. Obviously, the cheapest way is taking out as a loan. It's not taxable. That's why it's so cheap. You only pay corporate tax, which is $31,000, right? Take out entire $150,000 out as a loan. You still have to pay net income tax from C Corp, which is 21%, which is that $31,000. And then when you take out a loan, you have to pay, there's an imputed interest. So let's say you're at 2%, you're going to pay $3,000 interest a year. That interest is taxed at $900 something. In general, you're paying $32,000 tax if you do a shareholder loan. Shareholder loan, it is a temporary fix. You eventually have to take that money out. But let's say this year you have a very high tax bracket, you can do this to avoid, again, highly taxed on your dividend like this. The two other ways is, should you take out that $150,000 as 1099 for your spouse or your kids or to yourself, right? That's what you need to decide. Let's say you pay this out to yourself as a director fee, then you pay $48,000 versus 84. If you take it out as a W-2 employee, you pay $60,000 versus 84. So which one is the cheapest one? What you're gonna look at? Yes, this is the cheapest one, but this is a temporary fix because you will have to eventually pay off the loan and then take the money out. So this applies in very specific situation when you have more income. Whereas 1099 looks at, this is the easiest one. This not only calculates, look at how many things calculated when this happens. Income tax, there's a FICA tax, there's a Medicare tax, there's a net income investment tax, overcare tax. Some 1099 you also get QBI deduction. This gets factored in on how much tax you're gonna owe. So these all needs to be factored in. So understand this with your advisor, okay? So which one is the cheapest one? For this taxpayer, it happens to be 1099. Now, I know about, hey, are you guys sure you want to be S corporation or not? I think we have a video on our YouTube. Go and watch that. It talks about when you as an entity gets taxed. It talks about C corporation, why this is not good. And then, in our tax planning with our clients, we give our clients, the efficient entity structure like this. We give them that. The video to explain this, but if you're not our tax planning client, reach out to us or talk to your own advisor, and this will be able to draft you a tax efficient entity structure based on your real estate, your non-rental real estate activities, your syndications, your other kind of, again, anything you have, any business, they should be able to draft you that. Okay, thank you so much. Please follow us so you can get more of these videos. Take care.